Okay, we're gonna cover Treasury securities, and I'm gonna cover what are they and how you can analyze them for an investment if you want to buy some. So overall, Treasury bills are short-term government securities. They sell them at a discount, and they don't pay any interest. And at maturity, you receive the face value of the security. And so we're going to look at a couple 4-week securities, maybe some 8-week securities. And we'll build like a automated template so you can analyze all of these. Should be pretty quick, pretty straightforward. So here I'm at treasurydirect.gov. Anyone can come here. You can create an account, connect your bank. You can buy securities directly from the government. They have these auctions that come out. You can see the upcoming auctions, everything that's coming. That's what I'm looking at right now. So I see this latest is this 4-week bill, and it looks like they're issuing it next week. So like Monday, maybe 7, 8, 9, or like Tuesday or something. So anyways, I'm clicking here, and then we're gonna take a look at this 4-week security. So we need a couple things first. We need the issue date and the maturity date. So that's the price per $100. Put this here for now. So the issue date is 12/9/2025, and it matures 1/6/2026. All right. The current price is 99,713,778. Remember, these are at discounts, so you never pay the full $100. You're gonna get it at a discount. I'll format all of this after. For now, let's just get what we need. So we want to calculate our holding period return, so you know what's your return on this security. But in order to do that, we got to figure out how many days we're gonna hold it. So we'll do the maturity date minus the issue date. The issue date is the day they actually issue the securities, and they're gonna mature on the 6th, the day you get your money back. So it looks like 28 days. We're gonna hold it. 4 weeks makes sense. And then we can calculate our HPR. HPR is holding period return. In order to do this, it's pretty straightforward. We would take $100, which is the like the face value. I'm gonna lock the sale, and then we're gonna subtract the current price, basically, and we'll divide by the current price. Let's turn this into just a number. You can see this is our holding period return, small amount. And now we can calculate our annualized holding period return. This means that after 28 days, you took your profits and you invested it again into a similar holding period return. This is the return you would get. And to see the return you would get, we'll do 1 plus the holding period return. And then there's 365 days in the year. We have it for 28 days. So if we kept reinvesting the security for an entire year at this same return, that'll equate to a 3.81% return. And we'll test this in a second. Okay, so now we know this is the investment here. We know we're gonna hold it for 28 days. We know the holding period return is this number here, 0.002870. Annualized holding period return is 3.81%. And so now we consider our investment. So let's say we have $10,000 to invest. How much is it gonna cost us? So remember, you pay a discount, you don't pay the full thing. So they will never deduct the full amount from your bank account. They're gonna take your investment amount times the discount, just that price. And if you notice, I divided this by 100 because it's price per 100, and this investment is 10,000. So they're only gonna take 9971 from your bank account. So your profit on this is the investment minus the cost. $28.62, roughly rounded to $29. So then we can also see, what if you wanted to achieve this though? You wanted 3.81%. Well, you could keep turning this out. So 28 days later, you say, okay, great, I got my $29 back, but I don't need to spend it. I can do this again. And you wanted to see what that would look like. So let's check it out. So annualized investment. Let me open this so you'll see. You would take the cost, which is 9971, times 1 plus our holding period return, which is this. And then it'd be 365 days in a year over 28. Then it'd be this amount here, $10,351. And then we can test this return. Effective return, we can say 10,351 divided by, this is your investment. This is what you get back, 10,351. And this is the amount that left us, 9971. So your total divided by what it cost you, minus 1. You see this is our 3.81 that we discovered over here. And so overall, we're saying for 28 days, we can get a return that looks like, what's this, like 30 basis points, roughly. 0.3, yeah. 0.3 basis points, 0.3%. Annualized is 3.81%. We want to invest $10,000. It's going to cost us $9,971. Our profit is going to be $29 over this 28-day holding period. So they're going to give us $29, but we say we don't need the 29. We want to keep doing this for the entire year, and that would get us $10,351 total. So the effective return of that would be 3.81%. And then I can move this, and I can say total profit would be 10,351 minus this cost, $380. All right, so let's automate this, and then we can add in a couple more to analyze. Let me format this a little better first. Maybe this color. Let's see. Inputs. Holding period return, you know that now. HPR is holding period return. These will be our outputs. Try to shorten this a little bit. So annual investment. Investment cost, profit, annualized investment. Yeah, that's pretty clear. Or maybe we can say days, holding period return, annualized, holding period return. Investment cost, yeah, I think so. Here I just put do it like this, so it's clear. Like, do the annualized amount. All right. now we can take a look at a couple more. There's another 4-week security here. Let's see the yield on this one. So they issued it $12.2, and you see here the maturity date is $12.30. Okay, and the discount was 99696278. So off rip, you can see the newest securities that are coming out, they offer less of a discount. The older securities have more of a discount. But the Fed not too long ago announced that they were going to lower rates. So you can see those effects. And then you can see that this older one, the one that's going to mature in a couple weeks, had a higher return. And they got a little more money back. So, and you can do this for any. So we'll go back to the latest, which is this one. We'll do this 8-week. We do this 8-week and this 17-week. So this 8-week one, they issued it 11/12. The maturity date is 1/6. And the price is 99.417153. And then the 17-week security, they issue date of September 9th, 2025, and the maturity date is 1/6. Okay, same. 689347. Okay, and this is the price per 100. So check this out. You see the effective returns, they go up. And you might say, why? Well, the reason is you got to tie your money up longer. So you have to command a higher rate of return. Because anything can happen while your money's locked up, right? So let's format this similar to this. So this is something you can use to help you analyze some investments. Hopefully it's helpful. If you have any questions, you can always let me know. And maybe we can check out one more. This is 8-week security from not too long ago. So they had an auction a couple days ago. I think Thursday. Let's check it out. It's going to mature February 3rd, 2026. And the price is 99436889. That's the discount. So what you notice, just gonna move this next to this other 8-week one. So you can see the newer issue of the 8-week has a lower return than the older one. So you can see rates are going down. You notice the same dichotomy with the 4-week securities. This one's issued on the 2nd, higher return than the one issued on the 9th. And then this one issued back in November, higher return than the one issued on the 9th. So newer auctions seem like they're gonna have lower returns with the Fed lowering rates and things like that. So something to think about. Thanks for watching.